on the impact of a federal shutdown on small businesses. So, think of a federal government shutdown like this sudden jolt, right? It's a big shock to the U.S. economy, and it really hits small businesses hard, especially those without a ton of cash reserves. We're talking serious money, too, costing the country at least $250 million every single day it drags on. And, well, the pain happens in a few key ways. First off, cash just freezes instantly. The Small Business Administration, the SBA, they slam the brakes on processing all new loan applications. So that crucial money for growth, like those SBA 7A and 504 loans you hear about, gone. Just like that. And if you're a federal contractor, especially with a fixed-price deal, ouch. You're stuck paying your own team out of pocket, knowing you won't see that government payment until at least 30 days after everything reopens. But it's not just about the money drying up. Second thing is, the whole regulatory system basically grinds to a halt. Agencies you need for permits and licenses, think the EPA, the Environmental Protection Agency, they furlough tons of staff. So, getting that permit for your expansion or launching that new product, stalled, big time. Plus, you've got backlogs piling up at places like the EEOC, the Equal Employment Opportunity Commission. That means more legal risks and headaches that take months to sort out later. And finally, get this. The cost isn't just delayed, some of it's just gone. Forever. Economic models figure every week the government shut costs the U.S. economy around $7 billion. But here's the kicker. The Congressional Budget Office, the CBO, looked at the last big shutdown and confirmed billions, like $3 billion in economic activity. It never came back. It's just permanently lost. So, for small businesses, surviving this kind of targeted hit means you've really got to stress test your finances and check those contracts now to protect your cash flow.
Factoring can meet the cash needs of small businesses struggling with tariffs. Contact Chris at Versant Funding to learn if your client is a factoring fit.
Welcome to The Debate. Today we're tackling a recurring issue, the federal government shutdown. It's often described quite accurately, I think, as an acute shock to the U.S. economy. And looking back at the 2018-2019 shutdown, the Congressional Budget Office numbers were pretty stark. They estimated about $11 billion in reduced economic output overall, but the really concerning figure was that $3 billion of that output was just permanently lost, gone for good.
That $3 billion figure is, well, it's really the core of the problem, isn't it? It underscores that these shutdowns aren't just temporary disruptions. They inflict real structural damage that we're still trying to fully understand long after the political dust settles.
Right. And that brings us to our central question today. How does that permanent damage actually happen? What's the primary mechanism? Is it, as I'll argue, the immediate financial shock? The liquidity crisis that freezes capital and pushes vulnerable small businesses over the edge right away? Or, as you contend, is it more about the systemic, sort of creeping paralysis, the regulatory gridlock and administrative backlogs that build up and stifle growth and confidence over the longer term?
Right. And my position is that while that immediate shock is certainly sharp and painful for those directly affected, the truly widespread and unrecoverable damage comes from that accelerating long-term institutional paralysis. It creates these massive opportunity costs across the entire economy. It's about the growth that doesn't happen.
Okay, but I have to disagree on what constitutes the primary damage mechanism leading to that specific $3 billion permanent loss. I believe the evidence points squarely at the immediate liquidity crisis, the sudden stop in credit and cash flow as the main driver of permanent firm failure. And it's those failures that account for the bulk of that unrecovered output. So my argument really centers on the immediacy here. A shutdown, first and foremost, triggers a credit and cash flow crisis, especially for small businesses. The moment funding lapses, well, the Small Business Administration just freezes. Processing and approvals for new SBA 7A and 504 loans stop dead. That cuts off an absolutely vital source of capital for countless firms literally overnight.
And that's undoubtedly a huge blow for anyone in the middle of applying for those loans, yes.
Which gets even worse for federal contractors.
Because of the Anti-Deficiency Act, particularly for those holding fixed-price contracts, they're often legally required to continue certain essential work without any guarantee of immediate payment. So the small business effectively becomes an involuntary, short-term, zero-interest lender to the federal government. They're covering payroll, supplier costs, everything out of their own pockets, just hoping they'll get reimbursed eventually.
Which drains their working capital reserves very quickly. A major concern.
It's a critical vulnerability. This sudden, acute revenue shock hits the most financially fragile part of the sector hardest. Research suggests only about a third of small businesses are really financially healthy enough to weather something like this. And those less healthy firms, they're apparently 3 times more likely to fail when faced with an immediate shock like this. So when a firm collapses because it can't make payroll for, say, 3 weeks plus potential payment delays, that productive capacity is just destroyed, immediately and permanently. That's an interesting point you raised later about framing, though I would frame it differently. The damage is permanent because the firm itself is destroyed by that immediate lack of cash.
Okay, I'm sorry, but I just don't buy that the failure of already fragile firms fully explains that huge $3 billion figure. Let me tell you why I think that view is too narrow. Focusing only on the firms that collapse entirely misses the, frankly, billions in economic expansion and innovation that just never get off the ground because of the institutional paralysis. Yes, the cash flow crisis is acute, I grant you that, but the most insidious and widespread damage actually accelerates over time due to that paralysis, imposing these massive, often hidden opportunity costs.
So how does that play out practically? What does that look like on the ground?
Well, let's look at the regulatory side. Think about the EPA. When nearly 90% of their workers are furloughed, all the processing for new permits, inspections, environmental reviews, it just grinds to a halt. Now, imagine a small business, maybe in clean tech or biotech, that secured private funding for a new facility. But that funding is contingent on getting an environmental permit.
Which is a very common scenario, sure.
Exactly. That regulatory friction, that sudden stop, means their critical investment timeline can be stalled for months or even a year, according to some analyses. So the capital spending evaporates, construction gets pushed back indefinitely, expansion plans are shelved. It's essentially a government-imposed freeze on certain kinds of economic expansion. And that lost investment, that potential growth, it often vanishes permanently.
Those delays are definitely costly. I wouldn't argue that. But wouldn't you say that cost is realized over time, whereas the financial failure, the firm closing its doors, happens right now?
Does happen now, but the drag from the administrative side persists much, much longer, even after the government reopens. Think about the administrative friction. Agencies like the EEOC or the National Labor Relations Board shut down, right? Charges and cases just pile up. When they finally get back online, they face this overwhelming backlog. Evidence in ongoing cases gets stale, witnesses might become unavailable, the whole litigation process becomes, as some reports put it, inherently more expensive and drawn out. This adds a significant long-term administrative burden onto all the small businesses involved, not just the ones waiting for a check. So you see, the unrecovered output isn't just about the firms that fail immediately. It's also about these billions in stalled projects, lost investment, and the increased long-term compliance costs driven by this systemic uncertainty.
Okay, let's zero in on that specific $3 billion in unrecovered output the CBO identified. That figure represents something concrete that was lost forever. You're framing much of the damage as opportunity cost, projects that didn't start. I still maintain that the $3 billion is primarily a consequence of capacity destruction. A small business relying on a time-sensitive SBA loan or one forced to finance a fixed-price government contract out of pocket, they face a potentially lethal cash gap. You've got, say, a 3-week shutdown, plus maybe a 4-week delay in getting paid once things restart. That's nearly 7 weeks with little or no revenue. For many, that's fatal. And when that business shutters, its capacity, its contribution to the economy, isn't easily or quickly replaced.
But doesn't that perspective focus perhaps too narrowly on businesses directly tied to federal contracts or SBA loans? I mean, if a contractor is so fragile it can't survive a 7-week gap, arguably it was already operating on the edge. The larger, more systemic loss, I believe, comes from the erosion of general confidence across the entire economy. Remember, the 2019 shutdown triggered the sharpest single-month drop in the University of Michigan Consumer Sentiment Index since way back in 2012. That's a broad-based hit to confidence.
Okay, but what does that drop in sentiment actually mean in concrete terms for, say, a local restaurant or retailer not involved with federal contracts at all?
Well, that collapse in confidence translates directly into delayed private sector decisions. Consumers put off buying a new car or making home improvements. Businesses postpone hiring that next employee or hold back on planned investments. When these decisions are deferred indefinitely because of what some call the fog of policy war created by the shutdown, that economic activity often just vanishes. It doesn't just get delayed, it's lost. And that government-mandated pause on expansion, especially due to stalled permits, think about a multi-million-dollar clinical trial needing FDA sign-off or a new manufacturing plant needing EPA permits, that lost investment represents, I would argue, a far greater unrecovered opportunity cost than the failure of even several small, vulnerable contractors.
I understand the confidence argument, I do. But look at the immediate, tangible pressures placed on firms just to survive the shutdown itself. The administrative burden is immense, even during the crisis. For example, contractors are advised they must create a specific, dedicated accounting code just to meticulously track things like idle employee time. Why? So they can potentially file what's called a request for equitable adjustment, or REA, later on.
Right. Maybe we should pause and quickly define the REA for listeners. It's not everyday terminology.
Good point, yes. An REA is basically the formal claim a contractor submits after the shutdown ends, asking the government to cover costs incurred because of the shutdown costs not originally part of the contract, like paying staff who couldn't work. The very fact that firms have to divert precious accounting resources during the crisis just to prepare for this complex, uncertain future claim, well, that proves how immediate and disruptive the financial shock is. It forces them to pull resources away from their core business just to manage the fallout.
And that's precisely where the regulatory and administrative friction compounds the problem and inflates that unrecovered loss. The REA process itself is a perfect example of an administrative hurdle that, frankly, disproportionately harms micro-businesses. Let's be realistic. Does a small 5-person IT contractor really have the internal legal and accounting expertise or the funds to hire external experts to navigate the incredible complexity of documenting, submitting, and negotiating an REA claim against the federal government?
Probably not easily, no. It's a significant burden. Exactly. So this administrative complexity means that many perfectly legitimate claims for financial recovery are simply abandoned. The cost and hassle of pursuing the claim outweigh the potential payout, especially for smaller firms. So the unrecovered loss isn't just the initial cash shortfall, it's magnified by the costs of navigating this bureaucratic maze that the shutdown itself created. It further penalizes the smaller, less resourced businesses. If we shift gears slightly, think about sectors that aren't necessarily waiting on a contract payment, but rely entirely on basic government functions. The structural paralysis hits sectors like tourism incredibly hard, especially in localized areas. Gateway towns, whose economies depend heavily on national parks, suffer immediate, devastating revenue loss when those parks close or operate with skeleton crews.
This isn't just about lost ticket sales. It risks long-term brand and infrastructure damage that can depress tourism for seasons to come. This seems like a clear case of severe, geographically targeted administrative failure flowing directly from the government's inability to perform its basic operational duties.
Okay, I see why you frame it that way, but let me offer a different perspective on that tourism impact. While yes, the closed parks are the visible symbol, I'd argue the primary economic hit to local tourism and retail businesses, especially in areas with a large federal presence, is ultimately a consequence of the financial shock hitting the federal workforce. When you have hundreds of thousands of federal employees suddenly furloughed or working without pay, that creates a massive immediate hole in local income, and that translates directly into reduced consumer spending.
A classic demand-side shock, essentially.
Precisely. It hammers the local coffee shops, the mechanics, the restaurants, the small retailers near government centers. That's a demand depression that stems directly from the liquidity crisis affecting federal workers' paychecks, which then cascades down to the small businesses that serve them.
But have you considered the agricultural sector in this? They face really unique, often globally significant strains when federal support systems just stop. Think about time-sensitive things like crop insurance processing, subsidy payments, or even market reports. Halting these affects highly specific planting, harvesting, and trade cycles. That feels like an administrative failure with ripple effects far beyond local consumer spending, potentially impacting international commodity markets. If a farmer misses a critical window for financing or support because an office is closed, that opportunity might be gone for the entire year.
Which brings us, I think, quite neatly to the question of policy fixes. If we agree that permanent damage occurs through one or both of these mechanisms, where should the most urgent policy focus lie? From my perspective, the most urgent fixes have to address the liquidity shock, because that's about ensuring the basic survival of the firm right now. Policy should focus on making those critical contracting and lending functions more resilient. For instance, why not create something like a dedicated SBA shutdown reserve, a fund capable of maintaining essential loan processing for, say, 60 days, even if appropriations lapse? That could prevent the instantaneous credit freeze that we know kills vulnerable businesses.
I definitely appreciate the need for that kind of emergency measure, that financial triage. But focusing solely on reserves feels like treating the symptom, the firm's fragility in the face of a cash gap, rather than the underlying disease. The ultimate goal surely must be to structurally decouple these core economic functions from the volatility of political appropriations disputes. That requires more systemic reform, perhaps something like an automatic continuing resolution, or ACR.
Right, which, just to clarify for our audience, is basically a pre-agreed mechanism that would automatically keep funding non-controversial government operations at existing levels if a new budget isn't passed on time, preventing a full shutdown of essential services.
Exactly. By having an ACR in place or something similar, we could potentially safeguard those critical regulatory functions like the EPA and FDA permitting we discussed that have such long-lasting impacts on commerce and innovation when they get paralyzed. It's that structural paralysis, that long-term drag, that poses the biggest systemic risk, in my view, and that requires a structural preventative fix, not just a temporary patch.
I would certainly acknowledge that from the contractor side, there's a crucial due diligence step they already have to take. They need to carefully review the availability of funds clause in their contracts. That's usually FAR 52.232-18. Understanding that clause is critical for them to grasp the immediate financial risk they shoulder the second a shutdown looks possible. It highlights the existing structural financial vulnerability.
And conversely, I absolutely concede that the massive backlog of unpaid invoices that builds up, leading to payment delays that can stretch 30 days or more after the government supposedly reopens, well, that's a clear failure of administrative continuity that significantly worsens the financial strain Advocate describes. We desperately need better emergency protocols within the Federal Acquisition Regulation, the FAR, to ensure prompt payment for work that's already been completed and accepted. That administrative bottleneck needs fixing.
So, to summarize my position, the weight of evidence, as I see it, points to that immediate liquidity shock, the SBA loan freeze, the involuntary financing forced upon contractors as the primary trigger for the permanent failure of the most financially vulnerable firms. It's this rapid destruction of productive capacity that most directly explains the $3 billion in permanently unrecovered GDP identified by the CBO. Therefore, preparedness measures focused on immediate liquidity and financial resilience are paramount.
And summarizing my view, the shutdown is fundamentally an administrative crisis whose economic damage accelerates over time. The enduring unrecovered loss stems largely from regulatory paralysis, the buildup of compliance backlogs, and the pervasive uncertainty created by the fog of policy war. This combination stifles investment, innovation, and growth long after the shutdown ends, imposing huge opportunity costs. Therefore, structural reforms like designating key economic functions such as permitting and lending as truly essential and insulating them from appropriations battles
are needed to prevent this recurring systemic friction.
Well, I think our discussion today really clarifies the two major ways these shutdowns inflict lasting harm. Whether you see the primary damage as an acute financial collapse hitting vulnerable firms now, or as a protracted regulatory and administrative gridlock imposing long-term opportunity costs, it's clear both mechanisms put significant, often permanent strain on the small business sector. It certainly underscores just how complex it is to manage economic resilience when politics disrupts basic government function. And there's definitely more to explore in quantifying and perhaps mitigating these distinct yet intertwined forms of economic damage.
Factoring can meet the cash needs of staffing companies looking to expand. Contact Chris at Versant Funding to learn if your staffing client is a factoring fit.
Welcome back to the deep dive. This is where we take all that dense source material, the CBO reports, economic forecasts, all that deep research, and we really try to pull out the essential knowledge you need. Today, our mission is, pretty focused. We're tackling the economic fallout from a federal government shutdown. Specifically, we're looking at the impact on America's small businesses, which, as the sources show, is often disproportionate and, frankly, really damaging.
Yeah, and it's interesting because the media usually focuses on the political drama in D.C., but what the sources we looked at reveal is something much more fundamental happening under the surface. A shutdown isn't just politics. It's an acute shock, non-cyclical to the whole U.S. economic system. It really acts as a measurable, immediate crisis in liquidity and regulation for businesses. And many of these businesses, they're running on fumes, very thin margins.
That's a really important distinction. This isn't a slow burn like a recession. It's instant. Government-mandated paralysis, almost. So our goal here is to explore what you called the friction economy. We want to map out exactly how that paralysis in D.C. jams up Main Street's engine, right? We need to trace the threats, financial, contractual, regulatory, that pop up the second that funding stops.
Absolutely. And if you need just one number to grasp the scale, think about this immediate financial hit documented in the sources, past full shutdowns. They've been estimated to cost the U.S. economy over $250 million per day.
Per day.
That's tangible economic output just vanishing instantly, before the political arguments even quiet down.
$250 million gone every 24 hours. Okay, let's get past the theory. Let's talk about how the system actually breaks.
Well, first off, we have to admit this isn't exactly a new phenomenon, right? It feels like a recurring feature of our fiscal landscape. I mean, the U.S. has seen 14 funding lapses just since 1980, and they usually aren't accidents. They tend to come from these deep structural disagreements on fiscal matters, spending levels, debt ceilings, social priorities, clashes between Congress and the White House.
And the mechanism that causes the economic damage, it seems simple on the surface, but the effects are just devastating. It's furloughing non-essential government workers, stopping their pay. We often focus on the workers, understandably, but it's the operational halt that kills commerce, isn't it? Take the Small Business Administration, the SBA. Their contingency plans often involve furloughing, something like 23% of their staff?
That's right. Nearly a quarter of the people who process the capital for the nation's small businesses gone overnight. That creates an immediate nationwide problem.
Okay, so that's the immediate mechanism.
And that's why the financial impact isn't linear. It actually accelerates. It gets worse faster the longer the shutdown drags on. As that disruption goes past, say, the first week, market stability really starts to erode. Private sector confidence just tanks. It becomes this self-fulfilling prophecy of instability.
And this is where the sources give us some hard numbers on that friction, right?
Exactly. We have economic models, like from EY Parthenon, giving very specific estimates. They figure each week of a shutdown shaves about 0.1 percentage points off U.S. GDP growth on an annualized basis.
0.1% per week. What does that translate to in dollars?
That works out to a direct economic hit of roughly $7 billion per week. That's lost sales, delayed investments, consumer confidence just evaporating, real money, real impact. But here's what's really crucial, I think. It's the finding that kind of dismantles this myth of recovery. The common idea is, well, federal workers get back pay eventually, so the damage is just delayed. Then it all evens out.
Right, that's the narrative you usually hear. Oh, they'll get paid eventually.
But the Congressional Budget Office, the CBO, they completely debunked that after the 2018-2019 shutdown, that 5-week partial shutdown.
Ah, yes, the CBO report. That feels like the smoking gun here, the thing that changes the whole conversation.
It really is. They estimated that shutdown cut overall economic output by $11 billion over the next 2 quarters. 11 billion.
Okay, that's a big number, but the back pay argument still lingers.
But here's the kicker. The CBO determined that $3 billion of that lost economic output was never regained. It just vanished. Permanently.
Yeah.
A systemic loss.
$3 billion gone forever. That's
Yeah.
shocking. It completely reframes the political talk, doesn't it? It means this isn't just like accounting delays or rounding errors. It's productive capacity that's actually destroyed.
Exactly.
Can you walk us through how that happens? What physically disappears to account for that permanent $3 billion loss?
Well, think about the small businesses that actually failed during that 5-week freeze. Maybe a company was right on the edge of getting a crucial loan, or they needed a federal permit, like right now, to start building a factory. If the shutdown delay meant they defaulted on another loan or lost a key investor, well, that business, that productive capacity, it's gone forever. If that company fails, the jobs they would have created, the revenue they would have generated, that's the $3 billion in lost opportunity. You can't bring that back just by giving federal workers their missed paychecks later.
That makes sense. It's the lost future potential. Beyond that direct loss, there's also this massive erosion of confidence you mentioned.
Yeah, the 2019 shutdown, for example, it triggered the sharpest monthly drop in the University of Michigan Consumer Sentiment Index since way back in 2012.
And why is that index so important?
Because it's what we call a leading indicator. When consumer sentiment plunges like that, it translates directly into people putting off big purchases, cars, appliances, home renovations. They just wait. And that immediate pessimism, that pullback in spending, it feeds right back into slower sales. For every local small business owner, retail, manufacturing, services, it just compounds the financial squeeze.
And layering onto this instability is something the sources call the fog of policy war. What's that about? The suspension of government data.
Exactly. Think about it. Financial institutions, investors, even policymakers themselves, they rely on timely economic data. Inflation numbers, jobs data from labor, housing starts, stuff like that. It's critical for making informed decisions about lending and investment. So when the government agencies that collect and release that data suddenly close their doors, you get these huge analytical blind spots. And what happens? Banks, lenders, they react to that uncertainty by becoming way more cautious.
Which means
tighter credit, restricted availability, tougher underwriting standards, and inevitably higher borrowing costs for any small business trying to get capital, just when they might need it most.
Okay, so the macro picture is clear. Permanent damage, lost output, tighter credit because of data gaps. Now let's really drill down into the immediate operational crisis for small businesses. And that seems to start with the complete shutdown of federal lending, particularly through the SBA.
Yeah, the halt of the SBA loan guarantee system.
Yeah.
It's probably the most acute, most immediate threat to Main Street. It's like the government suddenly clamps shut the main artery for small business capital. Thousands of deals just stop dead in their tracks.
Let's clarify exactly which parts stop. We're talking specifically about processing and approving new SBA 7A and CDC 504 loans, correct? And maybe remind us why those two programs are so critical.
That's right. The sources really focus on those two because, well, they're the bedrock of financing for small business growth. The 7A loan is the most common one used for general working capital, expanding the business, sometimes buying an existing one. The CDC 504 program, though, that's crucial for buying fixed assets, things like land, buildings, major equipment. So when both of those programs just freeze, it's a full stop on both day-to-day working capital and the long-term investments businesses need to grow across the whole country. Instantly.
And this paralysis is total. It even hits lenders who usually have, like, special fast-track authority.
Absolutely. Even lenders in the Preferred Lenders Program, the PLP, or the Express Lenders, who normally have delegated authority to approve loans without waiting for SBA pre-approval. That advantage just vanishes. They're explicitly prohibited from issuing new loans during a shutdown. Why? Because the underlying guarantee, the government backing that makes the loan possible, it's funded by appropriations. No appropriations, no guarantee, no new loans. They simply have to wait until the government officially reopens.
Is there any wiggle room at all? What if a small business owner thought their deal was basically done right before the shutdown hit?
The only exception, really, that the sources note is for loans that had already been assigned a specific SBA loan number before the funding lapsed. If you had that number, the commitment was technically already made, so the disbursement could often still proceed. But I mean, if you were a small business just waiting on that final approval letter, or your loan package hadn't quite gotten that number assigned yet, you're stuck. Indefinite financial limbo.
So that immediate freeze on even the fast-track lenders, it basically turns a political fight in D.C. into this widespread credit crisis for private businesses. And it has nothing to do with whether the borrower is actually creditworthy.
Exactly. But the pain doesn't stop with just new loans. What about businesses that already have SBA-backed debt? A shutdown throws them into this really tricky compliance limbo. Now, essential things like limited loan servicing, maybe processing liquidations, those technically continue. But the capacity is slashed because of those furloughs we mentioned. So even routine servicing actions, things businesses rely on for flexibility, get massively delayed.
Can you give us a concrete example? Like, what kind of routine thing could suddenly stall a business?
Okay, imagine a small manufacturing firm. They suddenly need cash, maybe for a big inventory purchase. They decide to sell an old piece of equipment that's pledged as collateral on their SBA loan. Simple enough, right? But selling it requires a technical release of that collateral from their bank. And the bank, in turn, needs the SBA's official sign-off on changing the loan terms, the covenants. Now, if the handful of SBA staff still working are swamped with only the absolute worst emergencies, that simple request for a collateral release, it could just sit there, untouched, for weeks. If that sale was time-sensitive, the business could suddenly find itself in technical default or breaching its loan agreement just because the agency needed to process a minor adjustment. It's basically offline.
Okay, that's a nightmare scenario caused by paperwork delays. What about disaster loans? There's a mandate there, right? They're supposed to continue.
They are. Disaster loans are generally considered essential for protecting life and property, so they continue. But, and this is a big but, the sources are really clear. Processing times become demonstrably slower than normal. All right, limited staff again. So for a small business owner reeling from a hurricane or a wildfire, waiting extra weeks for essential recovery funds, that delay can literally be the difference between reopening their doors and closing down for good.
And earlier you touched on the indirect damage. The way the SBA freezing up affects the private capital market, too. Can you elaborate on that?
Yeah, it's a systemic ripple effect. Private lenders, they see the government shut down. They see the SBA, the government's main tool for backing small business risk grind to a halt. And what does that signal to them? Uncertainty, risk. So almost instinctively, they tighten their own belts. They raise their underwriting standards. They demand higher interest rates, stricter terms, even for loans that aren't seeking an SBA guarantee. So the very moment a small business might need a quick non-SBA bridge loan, maybe precisely because the shutdown caused a cash flow gap, they find that private capital is suddenly more expensive and harder to get. It's a double whammy.
Okay, so the SBA freeze is a credit crisis. The stop in federal contracting, though, that sounds like a massive, immediate cash flow shock, and it targets businesses that might otherwise be perfectly stable, right? Specialized firms working with the government.
Exactly. And that shock is governed by this really powerful but maybe not widely understood law, the Anti-Deficiency Act.
The Anti-Deficiency Act sounds incredibly bureaucratic. Can you break that down? Give us an analogy, maybe?
Sure. Think of it like the federal government's internal rule that says you absolutely cannot write a check unless you know for sure the money is already in the bank account. The instant appropriations lapse, the funding disappears, the government checkbook is Loctite. Agencies can't incur new obligations, so what do they have to do? Immediately issue stop work orders for all contractors deemed non-essential. And that forces these small firms, often overnight, to make really complex legal and operational choices.
Right, and this is where the type of contract they have becomes critical. It creates this, risk matrix for the business owner. Let's start with fixed price contracts, FP. What happens there?
Fixed price deals are probably the riskiest for the small business during a shutdown. Because the contract basically says you deliver this specific thing for this fixed amount, the business might actually be legally required to keep working. They have to operate under the assumption that the funding does exist somewhere and they'll eventually get paid. And the sources point out the devastating result. The small business effectively becomes an involuntary, short-term, zero-interest lender to the U.S. government.
Wow. Zero-interest lender.
Yeah. They have to drain their own cash reserves, max out their credit lines, whatever it takes, just to cover payroll, benefits, rent, materials, often for weeks on end, with absolutely no money coming in from the government for that work.
That sounds completely unsustainable for many firms. What about the other main type, cost reimbursement or CR contracts? Is it better?
It's different, but the work still stops. With CR contracts, the government is more likely to issue a formal stop work order fairly quickly. But the key here is prudence for the contractor. Let's say a formal order is delayed. If a CR contractor keeps working without that official go-ahead, any costs they incur during the shutdown labor and materials overhead might later be deemed unallowable, meaning not reimbursable.
So they risked eating those costs entirely.
Exactly. So the smart move, the prudent move, is to halt work immediately once funding lapses, even before a formal stop work order arrives. You have to protect yourself from racking up expenses the government might refuse to pay later.
Okay, but what if you're providing an essential service? Say, maintaining a critical IT network for national security. Your work can't stop, right? Are you safe then?
You still face a major financial shock, even then. Yes, your contract might be funded, designated essential, but who processes the invoices? Who approves the payments? Often, that's non-essential administrative staff.
Ah, so they get furloughed.
Right, so you keep working, delivering the essential service, but the administrative pipeline that gets you paid is completely frozen. The end result is the same. The cash stops flowing into your business.
This all leads to what the sources call the cash flow catastrophe, and we're not just talking a week or two delay here.
No, not at all. The consensus expectation, based on past shutdowns, is grim. Payment processing likely gets severely delayed, probably for at least 30 days, even after the shutdown officially ends.
30 days after it ends. Why so long?
Think about the backlog. Across every single agency, you have this massive pileup of invoices, contract modifications, closeouts, new spending requests that accumulated during the shutdown. The administrative staff comes back to an avalanche of paperwork. It takes weeks just to dig out.
Let's put some numbers on that. If a small contractor normally gets paid every 30 days and they go through, say, a 3-week shutdown, plus that 4-week backlog you mentioned.
That's 7 weeks.
7 weeks with zero expected revenue coming in. How does a typical small firm, maybe running on tight margins, possibly survive that kind of gap?
Honestly, many don't without taking serious damage. Think about a firm with maybe 15 employees. 7 weeks of payroll, rent, insurance, supplies, with no income. They have to burn through savings or take out expensive bridge loans, assuming they can even get one. That period of zero revenue, combined with potentially mounting interest costs, it's often enough to destabilize even companies that were perfectly healthy before the shutdown. And that leads right back to that permanent economic loss the CBO found. Businesses failing, capacity disappearing.
So surviving isn't just about having deep pockets. It also means taking on this huge, immediate administrative burden, right?
That's the hidden cost, absolutely. It's crucial. Contractors have to immediately pivot internal resources to just compliance and documentation. The moment a shutdown looks likely, they need to create a separate, dedicated accounting code instantly and use that code to meticulously track every single shutdown-related expense, non-productive idle time for their employees who can't work, the costs of safely shutting down operations and then restarting them later, any interest they pay on loans taken out just to survive the gap. It all needs to be tracked.
Why is that level of detail so critical, beyond just good bookkeeping?
Because it forms the entire foundation for potentially getting reimbursed later. It's the evidence for submitting a request for equitable adjustment, or REA. That's the formal claim you file with the government to try and recover those necessary costs caused by their shutdown.
Okay, the REA.
And this is where the administrative complexity just crushes smaller businesses. Big defense contractors, they have entire departments dedicated to government contracts and preparing these kinds of complex claims. Yeah. It's routine for them. But a small firm, they have to pull their owner or their key managers away from running the actual business, trying to find new work, managing the team, just to assemble these incredibly detailed technical REA packets. They often lack the in-house legal or accounting expertise.
So the cost of preparing the claim itself becomes a barrier.
Exactly. The sources suggest this often leads to businesses either under-recovering what they're legitimately owed or sometimes, tragically, just abandoning the claim altogether because the effort and expense of preparing the REA seems like it might outweigh the potential recovery, especially for smaller dollar amounts. They just eat the loss.
Okay, we've covered the immediate money problems, the lending freeze, the contract payment halt. But there's another layer of damage, right? The long-term stuff that comes from regulatory gridlock, this operational stagnation that can drag on growth long after the government reopens.
Exactly. This is about the friction that slows down innovation and infrastructure. It creates these bureaucratic log jams that impede business growth and actually increase compliance risks for months, sometimes even years, down the line. Essentially, any government agency that relies on annual appropriations and is responsible for issuing critical permits, licenses, or certifications, their ability to do that work gets immediately curtailed during a shutdown.
Let's use the Environmental Protection Agency, the EPA, as an example. How hard are they hit?
The EPA is a prime example. Under their contingency plans, something like 90% of EPA employees can be furloughed. 90%.
Wow.
So what does that mean? It means issuing new permits, say for manufacturers. That stops. Most enforcement inspections, halted. Approving state-level environmental cleanup plans, paused. the core functions just seize up.
And the impact on businesses needing those permits is it's stifling, especially for certain sectors. Think about small businesses in areas like clean tech or biotech or specialized manufacturing. They often need specific environmental permits just to start construction on a new facility or install new equipment or even launch a new product line. Delays from agencies like the EPA or the Food and Drug Administration, FDA, for approving a new medical device, or even the Bureau of Alcohol, Tobacco, Firearms and Explosives, ATF, for certain business licenses. These delays can stall multi-million-dollar projects for months. Projects that were ready to go, ready to create jobs and revenue, suddenly stop dead by bureaucratic inertia caused by the shutdown. It creates this long-term drag on innovation and infrastructure development. What about high-tech small businesses? Many rely on federal research grants like SBIR or STTR. What happens to that lifeline?
It's a bit mixed, but generally negative. Some programs, like SBIR, might be able to continue issuing awards if they happen to be funded through mechanisms outside the normal annual appropriation cycle. Some have multi-year funding or other structures. But overall programs support the mentorship, the guidance, and critically, the funding for new research initiatives across agencies like NIH or NSF that largely pauses. And that constrains the whole ecosystem that innovative small companies rely on for that crucial early-stage funding and scientific validation.
Okay, so permit stall, research funding gets shaky. What about the regulatory side hitting employers directly? Labor and compliance issues?
Yes, this is another area where gridlock causes real problems. Agencies that ensure a stable and fair workplace, they also face dramatic cuts in function. Think about the Equal Employment Opportunity Commission, the EEOC, or the National Labor Relations Board, the NLRB. These agencies rely heavily on investigators, mediators, administrative law judges, personnel, often deemed non-essential during a shutdown. We saw this clearly in past shutdowns. For example, the EEOC received thousands of discrimination charges, but during the shutdown, no new investigations could start. Mediations were canceled. Hearings were postponed indefinitely.
That sounds like legal limbo for both the employee filing the charge and the small business employer involved. They can't get resolution.
It's terrible legal limbo, exactly. And it creates significant long-term complications. Now, individuals can usually still file a charge to meet the legal deadlines, the statutes of limitation, but the processing stops. So you get this enormous backlog. When the agency finally reopens, it can take months, maybe longer, just to work through the pileup. By the time an investigation finally begins on a charge filed during or just before the shutdown, evidence might be stale, witnesses' memories fade, documents get lost. What does that mean? The whole process becomes inherently more expensive, more drawn out, and less likely to reach a fair or efficient conclusion. For a small employer, who probably doesn't have a big legal department, these escalating administrative and litigation costs associated with just trying to resolve these compliance issues become a major financial headache long after the shutdown itself is over.
Okay, so the shockwave spread wide, but the pain isn't felt equally everywhere, is it? Let's look at which types of small businesses are structurally most vulnerable when this kind of sudden shock hits.
Yeah, the sources really emphasize that the single biggest factor determining survival is simply financial resilience. How healthy was the business before the shutdown? There's prior research showing that even in normal times, maybe only about 35% of small businesses could be considered truly financially healthy. Meaning, they had decent cash reserves, manageable debt, and here's the critical part. Those less healthy firms, they were found to be 3 times more likely than their healthier peers to fail to close down or be forced to sell when hit by an immediate sharp revenue shock and a government shutdown. That's a perfect textbook example of that kind of acute shock.
3 times more likely to fail. That's stark. And which sectors tend to have more of those vulnerable firms, which get hit first and hardest?
The data consistently points to a few key sectors: accommodations, hotels, motels, food service restaurants, cafes, and educational services. Why them? Well, they often operate on really thin margins. They rely heavily on immediate day-to-day cash flow. And they're extremely sensitive to any shifts in local consumer demand. A shutdown hits all those pressure points at once.
And if we think about geographic impacts, the most devastating, perhaps, is the hit to tourism and these gateway economies, right? The towns right outside national parks and federal lands.
Oh, absolutely. That's a massive vulnerability baked into their economic structure. These communities, often small towns, rely enormously on visitor spending linked to those federal assets, national parks, national forests. We're talking about an estimated $29 billion in annual tourist spending nationwide tied to these areas.
Right.
When a shutdown closes the park gates or even just severely understaffs them so services collapse, the economic impact on those gateway towns is immediate and catastrophic.
Can we put a number on that? Maybe use one of the examples from the sources.
Yeah, Yellowstone National Park is a good example. In a typical year, just Yellowstone is estimated to generate something like $169 million in lodging revenue for nearby towns and another $56 million in recreation-related business guides, rentals, shops. You shut down Yellowstone, even partially. That cash flow just evaporates overnight. It hits seasonal workers who lose jobs, hotel owners with empty rooms, local guides with canceled trips, restaurants, gift shops, their suppliers. The ripple effect is huge. And losing those shoulder season trips, say in the fall, that can be devastating for businesses trying to make enough money to survive the winter. That income is just lost forever.
And it's not just the immediate loss of money, is it? The sources mentioned longer-term damage too, environmental and infrastructure problems.
That's right. We've heard from former National Park Service officials who warned about this. If parks are left technically open but essentially unstaffed, which has happened in some past shutdowns, you see immediate problems. Spikes in vandalism, trash piling up because there's no one to collect it, damage to sensitive habitats because there's no oversight. This kind of neglect during a shutdown doesn't just cost money to clean up later. It can cause real long-term damage to the park's reputation, its brand, and its physical infrastructure. And that hurts the local tourism businesses for years to come.
Okay, so that's the park's impact. Moving away from tourism, the other big localized hit is this sudden demand depression in places with lots of federal workers, right? Like D.C., Northern Virginia, other federal hubs.
Exactly. When you suddenly furlough hundreds of thousands of federal workers in a concentrated area and stop their paychecks, it's like creating an instant localized recession. These unpaid workers, facing total income uncertainty, they immediately slam the brakes on discretionary spending. Eating out, shopping for non-essentials, personal services like haircuts or dry cleaning, that spending just stocks. And that hits the local retail stores, restaurants, and service providers incredibly hard. It becomes a localized demand collapse in those specific geographic areas.
And does historical data show where the private sector job losses tend to concentrate during these shutdowns?
Yes, it's pretty consistent. Private sector job losses during shutdowns typically cluster in two main areas. First, professional and business services that reflects the federal contractors who get stop work orders or cancel contracts. And second, crucially, leisure and hospitality. That directly reflects the consumer belt-tightening, that localized demand depression we just talked about, as unpaid federal workers cut back their spending.
One last sector to touch on, agriculture. How are they impacted?
Agriculture faces a really unique set of pressures. Farmers and ranchers rely heavily on certain federal functions, things like processing government loans and subsidies, inspections needed for trade, market reports. Many of these processes are incredibly time-sensitive, tied to planting seasons, harvest windows, livestock cycles, international shipping deadlines. So delays in getting a farm load approved or getting the right certification for export, it can throw off their entire production and sales cycle for the year. It's not just an inconvenience. It can genuinely impact their ability to operate.
Okay, so we've established the damage is severe, it can be permanent, and it hits different sectors in specific ways. Given that the sources basically confirm this is a recurring structural problem in our system, what's the bottom line advice for small businesses? How can they possibly build resilience against a shock that's entirely political in origin?
Well, the absolute number one thing, the sources stress this repeatedly, is liquidity. Cash is king when this hits. So the most important preparation is for businesses to stress test their cash flow. They need to realistically model out what happens if all anticipated federal revenue contract payments, grant money, SBA loan disbursements stops cold for a minimum of 30 days. Run that scenario. See how long the business can actually operate. It forces you to identify your runway and your biggest vulnerabilities before the crisis hits.
That sounds crucial, and the advice based on that test is pretty actionable and definitely time-sensitive.
Highly time-sensitive. The single most important proactive step is to secure or increase emergency lines of credit before a shutdown even looks likely, certainly before it's confirmed. Why? Because as we discussed, private capital markets get nervous when government uncertainty spikes. Credit tightens almost immediately. Trying to get a new line of credit during the shutdown itself, it'll be much harder, more expensive, maybe even impossible. So, secure it before. And for businesses not directly tied to federal contracts, it's about aggressive accounts receivable management. Collect outstanding payments from all your other customers as quickly as possible to build up those cash reserves ahead of time.
Okay, so liquidity first. For federal contractors specifically, the preparation needs to go deeper into the legal side of things, understanding their contracts.
Absolutely essential. Contractors must pull out their contracts and scrutinize them, especially looking for clauses related to funding availability. The big one is the availability of funds clause, usually cited as FAR 52.23218.
FAR 52.23218, what does that basically say?
In plain English, it's the government saying, look, our obligation to pay you under this contract only exists if Congress has actually appropriated the money for it. Contractors need to understand that limitation. They also need to figure out, is my specific contract funded by annual appropriations? That's high risk in a shutdown. Or is it funded by multi-year appropriations or some other source that might be insulated for a while? Knowing the funding source tells you your immediate risk level.
And they need clear protocols for what to do when the funding actually stops.
Yes, crystal clear, predefined protocols, especially for cost reimbursement contracts. They need an internal rule. If funding lapses, we halt work immediately to avoid incurring non-reimbursable costs, even if the formal stop work order from the government is delayed. Protect yourself first. For fixed-price contractors, it's tougher, but they need internal financial triggers. At what point does the financial strain of continuing work outweigh the potential benefit? When do they pivot from performing the work to purely mitigating damages and focusing 100% on documenting costs for their future claim? They need to decide that threshold in advance.
And that documentation you mentioned earlier for the REA, the recovery claim, that seems absolutely critical for getting any money back later.
It's everything. The success of an REA hinges almost entirely on the quality and timeliness of the documentation. This isn't something you can reconstruct weeks later. That's why the advice is, create a separate, dedicated accounting charge code the instant a shutdown begins, or even looks imminent, not a week later, instantly, and use it to track everything related to the shutdown.
Like what specifically needs tracking?
Employee idle time hours, paid but non-productive because work stopped. Any direct costs of shutting down operations, like securing facilities and then restarting them later. Interest paid on any bridge financing you had to take out because of the shutdown. Even the managerial time spent dealing with the shutdown itself and preparing the eventual REA claim, track it all against that specific code.
And contractors often have other responsibilities that cost money even during the pause, right?
Yes, that's important. They're often still legally required to safeguard any government-furnished property equipment, data, IT systems. That requires labor, security, maybe utilities, even when the main contract work is stopped. Those are mandated, unfunded operational costs during the shutdown, and they absolutely need to be meticulously logged for potential recovery, too.
Okay, last area of preparedness. Mitigating the regulatory risks, the permit delays.
The best defense here is speed, trying to get ahead of it. If a small business has permits or grant applications pending, with agencies likely to be hit hard, EPA, FDA, state agencies reliant on federal funds, they should do everything possible to expedite those before the funding deadline hits. Push to get approvals finalized if possible. And crucially, stay vigilant about compliance deadlines. Don't assume that just because an agency like the EEOC is closed, that statutory deadlines for filing responses or taking other required actions are automatically paused. They might not be. The legal burden also remains squarely on the employer to monitor and meet those deadlines, even if the agency itself is unreachable. You need to track that carefully.
All right, we've laid out the costs, the permanent damage, the complex preparations businesses need to undertake. But the sources also look forward, right? They offer structural policy ideas aimed at actually fixing this recurring problem, or at least lessening the economic damage. Ideas to maybe decouple core economic functions from the political fights.
Yeah, that's the central theme running through the policy recommendations. How do we structurally insulate the private sector, especially small businesses, from these entirely predictable yet highly disruptive appropriation cycles? The most frequently discussed proposal is probably establishing some form of automatic continuing resolution, or ACR. The basic idea is a law that would automatically keep funding non-controversial government operations at existing baseline levels if Congress misses a budget deadline.
That sounds like common sense almost. Why is it so hard to get something like that passed?
Well, the political reality is that for some in Congress, the threat of a shutdown, that budget brinkmanship, is seen as leverage. It's viewed as one of the only tools they have to force negotiations or concessions on major policy disagreements. And ACR effectively removes that leverage point. But the economic argument for it is really strong. It would safeguard essential government infrastructure, keep the lights on for core economic functions like lending and payments, while allowing the political debates over the more controversial parts of the budget to continue separately. It prevents the entire system from seizing up over specific disputes.
And part of that is recognizing which agencies are truly essential for the economy, not just for national security or immediate public safety.
Precisely. We need a broader definition of essential. Key financial and regulatory functions simply have to be protected. Things like SBA loan guarantee processing, which we saw is critical to preventing that permanent economic loss, or Treasury's ability to manage debt, or the critical permitting offices at EPA and FDA that allow businesses to invest and grow. Designating these functions as essential, ensuring they remain operational during a lapse, would prevent the kind of systemic credit crisis and regulatory paralysis we've been discussing. Preventing the SBA pipeline from freezing should be non-negotiable for basic economic stability.
The sources also talk about dedicated contingency funds, right? Like setting aside money specifically for these situations.
Yes, particularly for the SBA. One major proposal is to create a dedicated SBA shutdown reserve. This would be a special fund set up outside the regular annual appropriations process, maybe capitalized, using a small portion of past SBA loan guarantee fees, for example. The idea is this reserve fund could be tapped only during a funding lapse, specifically to keep the essential loan guarantee processing functions running for a defined period, say 60 days. That would ensure the primary engine of small business capital doesn't just instantly shut off because of political timing in Congress.
And what about helping the contractors avoid that terrible cash flow catastrophe after the government reopens? That weeks-long payment backlog.
There needs to be reform within the Federal Acquisition Regulation, the FAR, the rulebook for government contracting. We need streamlined emergency protocols that would mandate agencies prioritize processing and paying invoices for work that was already completed before the shutdown began. If they could rapidly process payments for work already delivered and accepted, it would significantly reduce that massive administrative backlog and soften the cash flow crisis that hits contractors so hard for weeks after they're technically allowed to resume work. It's about clearing the decks quickly.
Okay, and finally, there was a specific recommendation for dealing with the devastation around national parks and those gateway towns.
Absolutely. Given the billions of dollars at stake in those local tourism economies, the policy suggestion is to create a clear mechanism that allows state or even local governments to temporarily step in and manage federal assets like national parks during a shutdown. They could use their own staff or temporary hires to keep basic visitor services running, prevent closures, and protect the park resources. But, and this is crucial, it has to come with a guaranteed, expedited federal reimbursement mechanism. We can't ask local governments to front the costs for fixing a national political failure, but allowing them to step in with guaranteed rapid repayment could prevent the arbitrary park closures and protect those vital tourism economies. #outro. So we just sort of boil it all down. The source material really paints a picture of this triple threat that shutdowns pose specifically to small businesses. You've got the liquidity shock, that's the SBA freeze, and the contractor payment delays. Then you have the regulatory paralysis, the crippling backlogs in permits and compliance, and finally the demand depression, the spending collapse in federal hubs, and the devastation in tourism areas. It hits them from all sides.
Yeah, and our look at the sources, especially that CBO finding about permanently lost economic output, that $3 billion just gone, it really confirms this isn't just delayed activity. It actually destroys productive capacity in the economy, which means for you, the small business owner listening, preparedness isn't really optional, is it? It's mandatory. It demands that really rigorous financial stress testing and that meticulous, auditable cost tracking that has to start the second uncertainty appears on the horizon.
And that really leaves us with a final thought, maybe a question for you, the listener, to mull over.
Right.
We know government shutdowns are basically an engineered, recurring feature of the American fiscal landscape now. They happen again and again. So what fundamental shift, either in policy or maybe even in corporate planning and risk management, is truly necessary to finally start treating these core economic functions, things like small business lending, contractor payments, essential regulatory processing, treating them like resilient national infrastructure, which they are,
right,
instead of just allowing them to be used as political bargaining chips year after year.
Commercial bakeries can benefit from the additional working capital factoring can provide. Contact Chris Lehnes at Versant Funding to learn if your client is a factoring fit.